Good afternoon, everyone. My name is Ajit. I'm the Chief Investment Officer of Asia Pacific Equities at RHB Asset Management. I'm based in Singapore. Thank you very much for attending this session with us today. The topic of my today's presentation would be Road to Recovery, 8 Reasons to Invest in China in 2021. So without further ado, let's jump right into the presentation. The first reasons why we think that you should be looking at China in 2021 is that I think China in particular would have better control of the whole COVID-19 new infection numbers. If you look at the chart here, you can see quite clearly that in US and UK, I think they are still struggling to contain the new number of cases for COVID-19. But if you look at other parts of Europe, Italy, France, and Germany, I think they are also struggling there, but definitely the situation is much better compared to what we see in US and in UK. And if we move on to Asia on this chart, I think in parts of Asia, I think some of the Asian countries are also struggling to contain the new COVID-19 numbers. I think case in point would be Indonesia. Indonesia is still pretty much in its first phase. The new COVID cases numbers are still climbing up higher and higher. But in other parts of Asia as well, if you look at Malaysia, obviously, if you look at Japan as well, and Thailand, I think the number of new COVID cases continue to climb, right? And that contrasts very drastically compared to what is happening in China. So from the large numbers that we saw, new COVID cases in 2020, as of now, the situation is very much controlled in China, albeit there will be some small breakouts like what we are seeing in Beijing right now. But all in all, I think China compared to other parts of the world and even within the Asian space, I think China has done very, very well compared to what we are seeing elsewhere. And in this case, we also would like to highlight in terms of the vaccines. So these are the 8 vaccines that are pretty much well advanced in terms of these clinical trials. The first 3 are from AstraZeneca, Moderna, and Pfizer, which are the more famous ones. But if you look at the other vaccines that are in advanced stages of trials, you will notice that 3 of them, for example, Sinopharm, Sinovac, and CanSino, these are all Chinese vaccines developed by Chinese companies. And why is that important? I think with 3 of the 8 vaccines that are in advanced trials, which belongs to Chinese pharmaceutical companies, that means that probably the Chinese population will be vaccinated at a much higher rate and will probably be able to resume normalcy as per pre-COVID levels much faster than anywhere else in the world. So on the vaccine front, once again, China is standing tall amongst other countries around the world. And on this point again, in terms of better control of COVID, you also see that in terms of the vaccine rollout, right, across all the different countries, in terms of China, I think they are expecting to roll out mass vaccination of close to 1 billion doses by 2021. I think this is well on its way, and if you think that if you take that statement in the context of the 3 vaccines that are in advanced trials, I think it's quite likely that China will be able to get its vaccine plan roll out much faster than anywhere else in the world. And the second reason why we think that we should look at China economy would be that in terms of the mobility of China compared to anywhere else in the world is much, much better. So on this chart here, we have the Google Mobility Index, which is essentially looks at the mobility levels at workplaces. Okay, at workplaces, on the left side would be for US and Europe. And you will notice that in terms of mobility relative to pre-COVID-19 levels, they are anywhere hovering between 30% to 40%. So which means in terms of utilization, right, we are looking at anywhere between 60 to 70% of the people are back to work. But if you compare that to Asia, Asia is definitely much better. But if you contrast it with what is happening in China, I think China is literally back to normal, right? Those of you who have friends in Shenzhen, Beijing, Shanghai, you will know that for them, they are back to normal. They are going to work, they're going shopping, they're going out eating, right? So I think in terms of the recovery of the economy, as indicated by mobility, right? So definitely China is much, much better than what we are seeing in other parts of the world. And on this chart here, in terms of the Chinese economy recovery, if you just look at the PMI, right, the red line here is the PMI of the Chinese economy. So just a recap of PMI. Yeah, a PMI of 50, above 50 means that the economy is actually expanding. The PMI of less than 50 means that the economy is actually contracting. So if you look at the red line here, which is China, you will notice that China PMI only had a very, very sharp blip in February of last year during the Chinese New Year when the whole country was locked down. But subsequent to that, right, it actually exhibited a V-shaped recovery, right? A V-shaped recovery that is that actually is much, much better than any of the regions that we see all around the world, right? So if you can contrast that with what is happening in US, in Europe, in Japan, in ASEAN, you'll notice that the recovery in China is it's much, much faster, and it's a V-shape compared to anywhere else in the world. And this is one of the main reasons that I think we should focus our attention on economies that are able to get back to its feet faster than anybody else, right? And if you can just look at the Chinese economy relative to Asia, once again, relative to Asia, you will notice that in China, the recovery also very much much faster, right? Even compared to the North Asia neighbors of Taiwan and Korea. I think Korea and Taiwan has done pretty well as well, but China, I think, stands out, right, in terms of the sharp and strong recovery that we have seen. I think one of the main reasons is I think China is big. It's able to sustain its own economy. It's less dependent on the external world. I think like what a lot of the earlier presenter has mentioned, right? For example, in Singapore, it's very, very, very exposed to the external economy. So that's why the impact is much, much bigger. But for China, right, such a big economy, it's self-sustaining. I think that's why it's able to weather it much, much better. And also, the other thing I want to highlight is also the structure of the economy. I think structure of the economy plays a part. If you look at Taiwan, Korea, China, I think internet, technology, plays a big part in the economy. So as we are well aware, the work from home phenomenon, the fact that we are having this conversation over Zoom, from different countries, points to the fact that I think the world that how we live, how we play, how we work has changed, and I think that will probably be sustained in the foreseeable future. So countries that play into that space will tend to do pretty well, right? And the third reason is if you just look at GDP alone, right? I think China's GDP, not just in 2021, which we know will be a recovery year, but also for 2022, right? For these 2 years, you can see that China rate of recovery is much better and much faster than anywhere else you can see in the world. So on this chart here, right, the last three rows are US, Europe, and UK. Developed market will rebound again, rebound nicely in 2021, but notice the extent and the quantum of the rebound. You will notice that it's still much, much lower than what we see compared to the Asian countries. But if you compare to China, well, China is definitely way ahead, right? So this is something I just want to highlight to everyone. And it's not just in 2020, but it's also 2021, but it's also for 2022 as well. So I think looking at GDP growth and see how the economy rebounds will probably give us a good guidance in terms of where we should be allocating our money. Right? So that's the third reason why we think that we should be investing in China in 2021. And the fourth reason would be, I think a weak US dollar is in general good for Asia, right? So I think I'm sure previous presenters have spoke about this. I think the consensus is that US dollar will be structurally weak from the fact that there's going to be the quantitative easing will continue to carry on for the foreseeable future. Fiscal stimulus will carry on. Fiscal deficit situation in the US will carry on, right? So and I think this is some of the main reasons why we think US dollar will be structurally weak. And in that kind of environment, like this chart has shown, historically speaking, right, a weak US dollar will be good for Asia, right? So this is something that I just want to highlight to everyone. And the fifth point I just want to highlight would be that if you look at valuations, right, just compare China's valuation. So obviously we know that I think stock markets have done pretty well. But if you look at valuations relative to different regions, right, I think China will stack up very well even relative with the stronger growth that we are seeing now, right? So if you look at China in terms of PE ratio, it's hovering about 16.8 times. Compare that with US, which is close to 25 times. Compare that with Europe, which is close to 20 times. But if you look at the EPS growth, right? So when we look at valuations, we need to look at the PE, but we also need to look at the EPS growth. The EPS growth on the 3 to 5 year basis for US is roughly about 13%. For Europe, it's about 10%. But if you look at China, it's 17% for the next 3 to 5 years, right? So definitely much stronger growth compared to anywhere else we see in the world. So definitely, I think that points to a fact that I think the Chinese stock market will tend to do quite well in that kind of scenario. And on top of that, we do have much cheaper valuations, right? Much cheaper valuation in terms of dividend yield and in terms of PER, which is price earning ratio, right? And on this chart here, similar to what I've highlighted earlier, but it's in terms of historical trend. What I've done is I've compared the PE ratio of US, Asia, and China. Obviously, China will be the red line, US is the white line, right? You can see that the US stock market is already very near its all-time high during the 2000 tech bubble. But if you compare that to China, we are still a long way from that. And also, if you look at not just versus its own history, but versus the different region as well. I think China stacks up very well compared to the valuations that we are seeing in US and in fact, even for the Asian countries as well. So versus its own history and versus other region, I think China is much cheaper, right? And moving on, and if we look at the 6th reason why we think we should focus our attention on China is this, okay? On this chart here, right, if you can focus your attention on this line here, and this number's minus $62 billion. Okay, what this means is during the whole COVID-19 crash of 2020, okay, it's close to $62 billion of foreign flows actually left Asia. So foreign flows, foreign money actually left Asia during the first half of 2020, because at that point in time, it was not known as COVID-19, it was more widely known as Wuhan virus, it was the Asia virus, right? So people were very worried about Asia, very worried about China. So as a result, the money just left this part of the world, right? So you can see quite clearly this big downtrend here. But if you look at the stock market, right, the stock market actually continued to power on, all right? But the point I want to highlight is this: during this whole entire period until the end of last year, only roughly about 1 billion of those foreign money actually came back to Asia, right? So a lot of this run up in the share prices was because of retail money, was because of domestic investors. So the foreign money have yet to come back into Asia. And I think that's a very important point. So the positioning of Asia is actually very light. And it's the same thing if I just narrow it down to China. So on this chart here, right, how you should read it is this, right? You can see this negative 435 bips. That's essentially the underweight that global funds have in their portfolio relative to their China allocation, right? So for fund managers out there, they will want to invest in China, but how they calibrate that is they will look at their benchmark, see how much should they overweight or underweight China relative to their benchmark, depending on whether they like China or not. Okay, but what this chart show is this, right? Compared to the last 20 years, 2 decades, right? The positioning in China is actually very light. And in fact, it is the lightest allocation that we have seen for China in the last 20 years. So that's why you can see this dip here, very sharp dip. So the point is, actually the foreign money, right? The foreign money, the offshore money for global investors have yet to come back to China. So I think this is a very powerful two charts that I think investors need to think about. I think obviously everybody is worried about the share price movement. And the share price have done well, but if you look at it, right, typically the market will only correct if, let's say, there's no more marginal buyer, nobody to buy stocks anymore. But if you look at these two charts, right, I don't think that's the scenario, right? Because if you look at the positioning, be it in Asia, be it in China, not many people are actually there. It's obviously well held by locals, well held by Asian investors. But other than that, right, I think China and Asia continues to be an underweight at this point in time, right? So this is something that I want to highlight to everyone. And the number 7th reason why we think we should invest into China is basically there's a change in US president. So during the Trump administration, right, I think China was the whipping boy, right? It was trade war, it was tech war, it was Huawei, it was Xiaomi, it was TikTok, it's a whole slew of events happened, and that definitely affected China's equity across the board, especially in the internet space, especially in the tech space, especially amongst the exporters. But right now, with Biden as the new US president, our view is that I think that's going to change, right? We are not saying that the US-China tension will magically disappear. It will not. But our view is that the escalation, right, the risk of escalation will definitely come down. Right? No longer are we going to worry about the midnight tweets from Trump and all the pressures that he's going to exert onto China, right? But for Biden, our view is that I think the pressure will be there because that is, I think America is definitely worried about the rise of China. But I think Biden will be a lot more presidential, a lot more predictable, a lot more rules-based, a lot more will be more diplomatic. So I think the market will welcome that, right? So the point is, I guess the bottom line is this. I think the worst of this US-China tension is probably behind us now that Trump is out of the White House, right? Now with Biden, right, I think there will be some form of reversal, or rather the aversion, especially for the Americans in terms of the Chinese equities. So during the last 4 years, right, China was a bad word. Global trade was a bad word. And unfortunately, right, this is what drives the stock market, right? But right now with Biden, I think once again, we will see a bit of a reversal there. So I think that will be positive for Asian equities as well as for China, right? And the other thing I want to highlight to everyone is this. Like I said, we don't think that the tension will magically disappear. It will not. But I think that what is here to stay is this. There will be a bifurcation of global technology supply chain. So what I mean by that is this. There will be a Anglo-centric supply chain or Western supply chain, and there will be a Sino-centric one, which is China's centric supply chain, right? What is interesting is this. The Western tech supply chain is very, very well known and very, very well held. But the Chinese tech supply chain is in fact very under-owned, right? If you think about it, right, it's only because of Trump. It's only because of the trade war, because of the tech war, that a lot of these Chinese companies are under pressure. So it's only within the last 12 to 18 months that they're feeling the pressure. And I think that you have read news about this. I think the Chinese government, the entire VC system in China, the entire tech ecosystem in China is coming together to try to support the Chinese tech companies and the Chinese tech supply chain. What is interesting for us as China investor is this. This is still very new, right? This is still very new. It only happened during the last 12 to 18 months. So prior to that, right, most Chinese companies were just assemblers. Nothing interesting about that. But now, if all these Chinese companies were to move up in terms of their supply, in terms of their value chain, I think it makes for very, very interesting investment opportunity. And this investment opportunity is it's not just once off, right? I think it's going to be multi-year. It'll be a generational kind of change. So I think the passing of the baton has started now, and it's all pretty recent. So that's why I'm pretty excited about that. And the other thing I want to highlight to everyone is this. Obviously, with this US-China tension, there will be winners and there will obviously be losers as well. So my point is, my job as a fund manager is to help my clients find the winners and try to avoid all the losers. So there's always a silver lining. There will always be companies out there who will benefit because of this US-China tension. And the case in point is this company M. This company M is a company that I invested in over the course of the last 12 months. Main reason I invested in this was because this is a China localization story. So this is essentially a Chinese semiconductor company, right? So by right, they should be very, very hard hit by the technology ban, right? And all the pressure that US has exerted upon them. But if you look at the earnings, if you look at the revenue, you will notice that it's year on year increasing, right? Because these guys are the biggest beneficiary. The top two guys in that space that they're operating in, they're the number 3 guys. The top 2 guys are all American companies. Now that US has banned US technology, what can this Chinese ecosystem do? They are never going to roll over and play dead. So they will try to support companies that they are able to substitute the US technology. And in a lot of cases, right, we are trying to find Chinese companies that will fill in that void. And I think that this will not be once off. The Chinese will only be threatened once. Subsequent to that, they'll never ever want to be threatened by this whole thing again, by Trump #2. So that's why I think that a lot of focus will be on this localization story. And I think that makes it a lot, very, very attractive for us to focus our attention on this particular theme, right? And the eighth reason why I think it's interesting is because of this, what we call a dual, the number of policies that has been acted over the course of the last few years because of the US-China tension. So this dual circulation model, I'm sure all of you had heard about it, but in actual fact, this is still very new. Xi Jinping first talked about dual circulation in May of 2020. So roughly speaking, we are only about 6 to 7 months away from the first time Xi Jinping actually used the word dual circulation. Point I want to make here is this is still very new. We know that once Xi Jinping talk about it, there's going to be some time before the policy comes into play. There'll be some time before that policy becomes actual implementation. So the point I want to highlight is that there's a lot of scope in terms of policies that I think the Chinese government can act over the course of the next few years. And it's not just in dual circulation. There'll be other sectors, like for example, in technology. Point I want to highlight to everyone is this: China actually imports 75% of global semiconductor in 2020. So if you ban semiconductor from being imported into China, the only way is China will have to be self-sufficient. They need to find an alternative solution. So I think that means that the scope for a lot of these Chinese companies, it's tremendous. The runway is tremendous. And it's the same thing for other sectors as well. On this chart here, I've highlighted energy because I think I think the US government is also trying to put pressure on the energy sector. And China actually imports 70% of the energy needs. So this is a very important sector to them. So they will focus on trying to get self-sufficiency in the energy sector. And that will include certain value chains, like for example, new energy cars, clean energy, and all of that. And that means that I think once again, the runway for this is actually tremendous, because like I said, it's only because of what has happened during the Trump administration. Did the Chinese government actually embark on this huge drive to have self-sufficiency and all this whole slew of different policies in order to buffer the economy. And on this chart here, some of these policies, I think all of us are quite well aware of, things like 5G, like AI, like IoT, data center, new energy. So these are things that are still relatively new, right? So I think that makes it very interesting for investors like us, because the scope for us to make money is actually very, very big. And I will also want to highlight in terms of our key flagship fund that we are managing. Our key flagship fund is our RHB Big Cap China Enterprise Fund. If you look at the performance of the fund, it's actually very, very good. Last year, despite a very, very difficult year, China actually went up roughly about 25%, but our fund actually performed close to 42%. So we actually outperformed the benchmark by about close to 17%, right? So if you look at the last 3 years when I've been managing this fund, we have outperformed every year in 2018, 2019, 2020, especially 2020, the outperformance has been very, very good. So I think, for those investors out there who wants to get exposure to Chinese stocks, I think Big Cap China is something that you can look at. And the last point I want to highlight is this. What is so special about Big Cap China Fund is that we are able to invest in H shares, which are Chinese shares listed in Hong Kong. We're able to invest in US ADRs, right, which I think is the crown jewel of the whole Chinese economy, and also invest into A shares. So I'm able to allocate between the 3 different baskets. So this is very unlike, for example, funds out there who can only invest in A share. Right, for me, I'm able to invest in 3 different baskets. So my opportunity set is much, much bigger. Opportunity for me to make money for my clients is also much bigger. So that's why I'm able to allocate amongst all these different pockets of alpha, what I like to call them, and therefore that results in this huge outperformance that we have seen. So once again, our performance last year for our Big Cap China Fund was a massive 42% year to date for 2020. And actually with that, I've actually come to the end of my prepared remarks. So over to the moderator if there are any questions.
Okay, thank you very much, Mr. Tan, for the session, and thank you for enlightening us about the China and how is it like moving forward. Okay, so I think the first question that we have here for you is, many China companies have been sanctioned by US. What would be the effect of the fund that is focused in China?
Sorry, are there any questions? Because I'm not able to hear.
Hello?
The moderator.
Can you hear me, sir? Hello, can you hear me? Hello, can you hear me
Sorry,
now?
can we say that again? Yes, I can hear
Yeah.
now.
So, yeah. Okay. Good. Yeah, we are back alive. So, many China companies were sanctioned by the US. What would be the
Mhm.
impact of the fund that is focused in China?
Okay, I think that's a very,
Yeah.
very good question. So let me talk about that. There are a few
Sure.
key areas that I think we should touch on. I think the first one would be the delisting of these US ADRs. I think this is something that a lot of investors are worried about. But my view is that, in fact, I think this is a loss to the US investors, to the US exchanges. In fact, this is actually good for Chinese investors, good for the Chinese companies, and also good for Asian investors. Okay, for one, these stocks are now being relisted or dual listed on the Hong Kong Stock Exchange. So it's trading within our time zone. Okay, so that's one. I think that will create a lot more interest. But the other thing I want to highlight is also that in terms of valuations, right? I think the Chinese investors are willing to give a higher valuation to these companies who are being relisted on Hong Kong. Why? It's because, simple reason is because they are the ones who actually use the products, right? They are the ones who use Taobao. They are the ones who use Weixin. They are the ones who use JD. They know the products better than Americans. So they know the importance and how good all these guys are. So they're willing to pay a much higher valuation, willing to pay up for these stocks. So if you look at the share prices of this US ADR who are relisted in Hong Kong, they have actually done very, very well. So from our, in terms of our portfolio strategy, so what we have done is we have shifted, we have screened for stocks that are able to get easy listing as a dual listing or as a secondary listing in Hong Kong or in China. Okay, so we have avoided those stocks who have trouble relisting if the Americans were to come in aggressive. So, and that strategy has actually panned out very, very well for us. So a lot of our position, right, are in positions of Chinese companies that are able to get easy listings. So if you look at some of the big China internet players, they have actually got their relisting in Hong Kong in a very, very short period of time. We were expecting that. But the time frame in terms of their relisting have actually taken us by surprise as well. So I'm not surprised if, let's say, someone in Beijing actually call them up and say that, you know what, guys, you need to help us out here. We need to get these all Chinese guys, Chinese ADR companies get listed on the US stock exchange as soon as possible, right? So, so on a few fronts, in terms of the valuations, in terms of the ease of secondary listing, we don't think that's going to be a major issue. Then the other issue is in terms of the entity list, right? There's a whole list of companies that the Trump administration has labeled or have blacklisted. Okay, but so from our perspective, right, we don't actually have a lot of exposure. In fact, minimal exposure to all these entity companies. So we're well aware of that was actually brewing for quite a while already. So we actually withdraw from that. So we actually avoided a lot of that carnage there, and we actually went on and buy stocks that did not were not affected there. So in fact, we went to buy stocks that were the beneficiary because of that entity list. So as a result, that's why our performance over the course of the last 2 months was in fact much better, compared to any point in time because of all this kind of structured events, right? So like I said, there's always going to be issues. The market is never going to be smooth, but the point is we need to find a silver lining. We need to find out who are the winners, who are the losers, and try to think along those lines, right? So this is where I think we can help generate alpha for our clients. And over to you.
I see. So, yeah, so that basically what Mr. Tai is trying to say is they have practiced some discretionary before making a decision in investing in the particular name. Is that right?
Yes,
Yeah.
yes, we try to find
Yeah.
who are the winners, like I said, who are the losers.
Mm.
I think there's always going to be, because of policies, because of market movements, because of
Yep.
tensions, there's going to be winners and there's going to be losers.
Yeah. Okay. So, Mr. Tan, would you be able to shed some light in the China semicon industry?
Okay, okay.
Yeah.
The China semicon industry, I think the worry that most people have is that are they able to catch up? Are they able to flourish with all this US technology ban? At this juncture, I think we are still, the Chinese companies are definitely behind their peers. Okay, that's for sure, right? Because I think this tech ban, this semiconductor ban has taken everybody by surprise. But my view is that knowing the Chinese government, knowing the Chinese companies, right, they have been threatened. They have been threatened once, and I don't think they ever want to be threatened again. So can you imagine the amount of resources, the amount of efforts, the whole of government kind of thinking that goes into it, trying to promote this very, very key industry. So I think right now they're definitely behind, but I will put my money on the fact that that gap is going to be narrowed over the course of time. Over the next 3 to 5 years, I think the gap is going to be narrowed. And not forgetting what I mentioned earlier, 75% of semiconductor chips are used by China, right? So this whole ban, right, hurts everybody, right? Hurts everybody from all the way upstream to downstream. It hurts everybody. So obviously the Chinese semiconductor companies are in the thick of it. So my view is, like what I said, my view is they can only improve, right? Because of the fact that they will never roll over and play dead. The Chinese are have made it very clear. AI, 5G, IoT, these are the things that they are going to concentrate on, and that's national policy at a national level, all the way from Xi Jinping downwards. They will put money and they'll put resources. The whole country is behind that, right? So my view is that gap will slowly narrow over time. Yeah,
I see. So bright futures ahead of these industries, yeah. Okay. Maybe the last question that I would like to hand over to you will be what would be your opinion based on the value propositions that China A shares and China H shares have?
sorry, can you say that again? Value proposition of China A share?
China A shares and China H shares. Yeah. How do you foresee them moving forward? Hello?
Sorry, can you say that again? I think the line is breaking up.
Oh, the line's breaking up. Okay, so sorry about that. Basically, the question is for China A shares versus China H shares, how do you foresee the value proposition of it moving forward? I think we have some technical errors here. I'm so sorry.
Sorry, can you
Hello,
say that again?
Mr. Tan?
I'm sorry, I didn't quite get your question.
Mr. Tan, I'm so sorry about the technical errors here that we have. Basically, the China A shares and the China H shares, what would be your opinion on it moving forward?
Okay, I'm just getting bits and pieces of the question. I guess the question is, what's my opinion of China A share versus China H and China and ADRs? Is that right?
No, China A and China H. Hello, Mr. Tan. Mr. Tan.
Yes, I'm here.
Yes, yes. Can you hear me now?
I can hear you now very clearly.
Yeah. Okay. So sorry for the disruption here. I think we have some interruption from our line. So the question here is, between China A and China H shares, how do you foresee them moving forward in the future?
Okay.
Yep.
From my
Yep.
perspective, right, I think each of the buckets that I looked at, right, have their own merits, right? The Chinese A share is very diversified. It represents in general some of the smaller companies that are out there, right? So that's why in Shenzhen and in Shanghai, roughly speaking, we are talking about 3,000 plus stocks that are listed in these two exchanges. So it represents a diversified pool. But having said that, right, I want to highlight is that a lot of these Chinese companies are on Chinese accounting standards. So the corporate governance, you probably need to look at it very carefully. I mean, that's what we are doing. So we are very careful when we invest into the Chinese A share because of that. But not to say that there are no gems there. There are. I think there are a lot of exciting companies there, which are national champions, and I think that makes for an interesting a change from what we have in other sectors, right? But having said that, the Chinese A share is in general a lot more frothy. It's a lot more retail driven, in fact, very retail driven, very speculative. So share prices need to do very well and they tend to come down very sharply as well. So you need to time it well. You need to do your work well, right? In terms of valuation, once again, right, it's very expensive. But if you look at H shares, right, only the best of the best companies are able to get listed on the H shares, right? So these Chinese stocks, right, are high quality companies. They are SOEs, they are very established, like the likes of Ping An, likes of Tencent, ICBC, the insurers, the banks, very well established. So they are a very good proxy for Chinese GDP growth in general. And valuation is actually very attractive. Right. And then, like I said, I'm a lot more comfortable with their accounting standards, with their corporate governance. So this is another interesting part. But valuation, once again, is much cheaper, right? We don't see the kind of explosive growth because these are the companies that are slow, steady growth, very strong companies, good dividend payers, right? But the other part that I think I want to highlight is also the ADRs. For me, right, the ADRs is a crown jewel, right? This is where all the internet companies are. Right, this is all where the tech companies are, and that is a big differentiator that Chinese have versus the rest of the world. So to me, right, that is a big key focus area. So now that a lot of these ADRs are being slowly being relisted or dual listed into Hong Kong, I think that makes it a lot more interesting as well because the Chinese are able to buy these stocks through the southbound connect.
Yeah. Okay, Ken.
I hope that answered that
Thank you so
question.
much, Mr. Tan. Yep, you did answer the question.
No
Thank you so
problem.
much for being patient with us. Thank you so much to the viewers as well
No
for being
problem.
patient with us at home. Okay, thank you very much. We'll see you soon. Right,
Thank you.
bye.
Thank you. Take care, everyone. Take care.
Thank
Bye
you.
bye.
Bye.